What if I told you that the secret to financial success might not be a high-paying job or a winning lottery ticket, but a simple understanding of two key financial concepts? I'm talking about assets and liabilities. In today's video, we're going to unravel the mystery of these two terms, exploring what they actually are, how they're different, and most importantly, why you should care. By the end of this video, you'll have a clear understanding of these concepts and be well on your way to making smarter financial decisions. And before we get started, if you're new here, make sure you subscribe and hit that bell icon so you don't miss out on our next videos. Let's start things off by talking about assets. In the simplest terms, an asset is something you own that has value. Think of it as a friend who's always ready to lend you a hand, financially speaking. The word asset comes from the old French word assets, which means enough. When you have assets, you're on your way to having enough for your financial goals. Now, there are many different types of assets, and they're not all created equal. For instance, cash, which is pretty straightforward. It's the money you have in your wallet or your bank account. It's liquid, which means you can use it right away to buy goods, pay off debts, or invest in other assets. Real estate is also an asset because it includes any land or buildings you own. Real estate can be a powerful asset because it can generate income through rent. Plus, property values often rise over time, which can increase your wealth. Stocks and bonds are also considered assets. If you don't know, when you buy a stock, you're buying a piece of a company. If the company does well, the value of your stock goes up. Some stocks even pay dividends, which is a portion of the company's profits distributed to shareholders. On the other hand, bonds are a safer option. They're like IOUs. You lend money to a government or corporation. In return, they promise to pay you back with interest after a certain period. Interestingly, if you own a business, that could be considered an asset too. Your business can generate income and potentially increase in value over time. Cryptocurrencies can be considered digital asset. They've gained popularity in recent years. They're volatile, but can offer high returns if managed properly. Now, here's the exciting part comes. Assets can generate income. For example, real estate can bring in rent, stocks can pay dividends, and a business can produce profits. Even cash can earn interest if it's in a savings account. Let's turn our attention to the other side of the equation, liabilities. If assets are your financial friends, then liabilities are like that friend who keeps borrowing money and never pays you back. In other words, liabilities are what you owe and don't see financial gain or wealth building from. The word liability comes from the Latin word ligare, which means to bind. Liabilities are like financial ties that bind you. The more liabilities you have, the less financial freedom you enjoy. Now, just like assets, there are several types of liabilities, and it's important to understand each one. First is, of course, loans. The money that you've borrowed and must pay back, often with interest. This could be a student loan for your education, a mortgage for your house, a personal loan, or a car loan for your vehicle. Credit card debt is also a liability. This is a form of unsecured consumer debt. It's easy to rack up, and it often comes with high interest rates. If you're not careful, it can quickly spiral out of control and cause you to pay large amounts of interest back to the creditors. Your expenses like utility bills, rent, or subscriptions might not seem like liabilities, but they're obligations you have to pay regularly. If you run a business and receive payment for goods or services that you haven't delivered yet, that's a liability too. You owe your customers those goods or services. All these liabilities can decrease a whole lot of your wealth. Every dollar you use to pay off your liabilities is a dollar that's not contributing to your assets and investments. And if your liabilities come with high interest rates, like credit card debt, they can eat away at your wealth even faster. The key difference between assets and liabilities are simple. Assets put money in your pocket, and liabilities take money out. Assets and liabilities also differ in terms of risk and return. Assets, especially investment assets like stocks or real estate, come with a degree of risk, but also the potential for returns. Liabilities, however, often come with a cost, interest, but don't offer a financial return. Let's say you own a house. If you live in it, it's an asset. It provides you with a place to live. But if you have a mortgage on it, that's a liability. You have to make monthly payments. Now, if you rent out a part of the house, that part becomes an income-generating asset. Let's take another example. If you buy a car with cash, it's an asset. It provides value by enabling you to travel, but cars depreciate over time, so the value of this asset decreases. If you buy a car with a loan, the loan is a liability, and you have to make monthly payments plus interest. And here's a fun fact for you guys. In accounting, the equation assets equal sign liabilities plus equity is known as the balance sheet equation. It shows that what a company owns, assets, is financed by what it owes, liabilities, and what its owners invest, equity. Up till now, we've talked about what assets and liabilities are and how they're different. But why does any of this matter? Well, as we mentioned earlier, the way you manage your assets and liabilities can make a huge difference to your long-term wealth. The first step to building wealth is to grow your assets. This could mean saving more money, investing in stocks, purchase income, generating real estate, starting a business, or even learning a new skill that could increase your earning potential. At the same time, you want to reduce your liabilities. So try paying off your debts as quickly as possible, avoiding high-interest loans or cutting unnecessary expenses. You also need to balance the risk and reward factors, keeping in mind that not all liabilities are bad. Some, like a mortgage or a student loan, can be considered good debt if they're used to buy an asset that will increase in value or generate income over time. Let's say you take out a student loan, a liability, to pay for a degree in a high-demand field. This degree increases your earning potential, an asset. Over time, the increased income more than compensates for the initial liability, leading to increased wealth. Building wealth is a long-term game. You have to make smart decisions today that will pay off in the future. This means regularly investing in assets, steadily paying off liabilities, and always keeping an eye on your financial health. Ultimately, the role of assets and liabilities in building wealth is about achieving that financial freedom. This is the point where your assets generate enough income to cover your expenses. At this stage, you're no longer trading time for money. Instead, your money is working for you. Did you know that Robert Kiyosaki, the author of the best-selling book Rich Dad, Poor Dad, popularized the idea of financial freedom through increasing assets and decreasing liabilities? His teachings have inspired millions to rethink their approach to wealth building. If you're a fan of Robert, we have a video on him. Unleash your wealth potential. Start earning passive income in 2024. We recommend you watch it! Coming back to our topic today, we've talked a lot about assets and liabilities and how they can impact your wealth. But even with the best intentions, it's easy to make mistakes when managing these financial elements. And one of the most common mistakes is confusing liabilities with assets. For example, many people consider their personal car an asset. But unless it's generating income, like a rental car, or paid in cash without a loan attached to it, it's actually a liability. It costs money for maintenance and insurance, and it depreciates over time. Another mistake is ignoring small expenses, like daily coffee or monthly subscription. They might seem insignificant. Let's say you buy a $5 coffee every day. That's a small expense, right? But over a year, that adds up to $1,825. That's money that could have been used to pay off debt or invest in an asset. Another mistake people make is taking on bad debt. Not all debt is created equal. Good debt can help you generate income or increase in value over time. But bad debt, like high-interest credit card debt, can quickly eat away at your wealth. Imagine you have a $1,000 balance on a credit card with an 18% interest rate. If you only make the minimum payment each month, it could take you over 8 years to pay off the balance and cost you nearly $1,000 in interest. Also, never make the mistake of ignoring the power of compound interest. This right here is a powerful tool for building wealth, but it can also work against you when it comes to liabilities. The longer you take to pay off your debt, the more interest you'll end up paying. Next up, we have some practical steps for managing your assets and liabilities more efficiently. Start with a financial audit. Make a list of all your assets and liabilities. This will give you a clear picture of your current financial situation. Then, create a budget. It's a financial plan that will tell you how you'll spend your money and be honest about it. It can help you increase your assets by saving more and decrease your liabilities by spending less. If you make a budget and find a way to save an extra $100 a month, that's $1,200 a year that could be used to pay off debt or invest in an asset. Talking about debt, if you have multiple debts, focus on paying off the ones with the highest interest rates first. These are the most costly liabilities. During this process, make sure you build an emergency fund. It's the money you set aside to cover unexpected expenses. Suppose your car breaks down and needs a $500 repair. If you have an emergency fund, you can cover this expense without taking on more debt. And lastly, educate yourself. Keep up with the latest trends, new types of assets and liabilities, and new strategies for managing them. We now hope you now understand the difference between assets and liabilities and why this knowledge is crucial for your financial success. If you enjoyed the info in this video, we'd love to hear from you. What's one new thing you learned from this video? Do you have any tips for managing assets and liabilities? Drop your comments below. And if you've any questions or topics you'd like us to cover in future videos, let us know that too. And before you go, don't forget to check out our video on how to start investing with just $1,000. Investments made easy in 2024. Make sure you hit that subscribe button and press the bell icon. Thanks for watching.